Welcome to an exceptional edition of Rebellion's educational series. I'm here with the brilliant portfolio manager, Malcolm Dorson. I've known the man for nearly 30 years. He's now the senior portfolio manager at Mirae Asset Management's emerging market fund, and he's here to tell us all about the world today. Thank you so much, Malcolm, for coming on.
Great to see you, Alex. Thanks for having me.
The pleasure is all ours. Emerging markets are hugely important right now. I'm embarrassingly ignorant on them, and I'm really excited to learn from you. So over the last 15 or so years, there's been enormous cyclicality in the emerging markets. Why is that? Where are we now?
Yeah, so you're right. EM equities and EM in general have always been a cyclical asset class, and to some degree a beta off of US performance. And I think part of this has to do with risk appetite and a search for yield. But at a higher level, the association with EM's connection with the US dollar, I think that's the key driver, because EM countries have always had the attractive prospects for growth, whether it be through their natural resources or their demographics or just a very low base of earnings. But with that said, these countries and the companies within them, more importantly to us, they've shown propensity to fund that potential growth with US dollar debt. And that makes sense given that the US has much deeper capital markets than EM countries, and that US investors, on the other hand, are also attracted to high yield issuances offered in EM. So that means every time the US dollar strengthens, either from a flight to quality event or more hawkish monetary policy environment, EM balance sheets tend to inflate, net interest expenses shoot up, and earnings decrease. So EM tends to suffer. And then to add fuel to fire, many of these economies are exporters of commodities. So considering the inverse relationship between the dollar and commodity prices, a stronger dollar hurts export-led growth in these countries. So long story short, we think now that we're facing a weaker dollar environment, that should translate into a new positive cycle for EM corporates.
One would assume with so many dollars being printed by our government, when you consider that was one out of every $5 or one out of every $4 has been printed in the last year and a half or 2 years, the amount of dilution that's occurring for, I guess, the dollar stakeholders is just unprecedented.
You're right. And I think that's a key driver for having asset allocators take a look at their books and sort of re-diversify from a geographical standpoint and from a currency standpoint.
So I've got the chair of University of Miami Endowment coming on our show tomorrow. What should I ask him?
I think that would be a natural question. I think in general, if you look at most institutional allocators right now, they have about a 5% allocation to EM equities. And they're funding that through US equities because it's really paid off over the past 10 years or so. But now that we're seeing this cyclical shift, it'd be interesting to see if someone from his chair is starting to make that change, is starting to alter more to international. And then how do they look at international between Europe and emerging markets?
Definitely. So I guess, how has the asset class evolved over the last decade?
Well, it's a good question because everything I just mentioned about EM being a cyclical asset class, EM has evolved to become less cyclical. Basically, these countries and companies are starting to learn their lessons, and they have through a lot of pain, for lack of better words. And so the EM landscape has changed and they've become more responsible. So first of all, EM economies have shifted away from asset-heavy, low-return industries like manufacturing, construction, and commodities, and really more towards services, innovation, and high-return business models. Just 8 to 10 years ago, materials and energy represented over 30% of the index. And today that number has more than halved to about 12%. It's really scaled down tremendously. And not only commodities, industrials, utilities, real estate, all of these have almost halved as well. While at the same time, what's growing is information technology, communication services, and consumer sectors have really grown their representation significantly. And then from a geographical standpoint, you've seen Asia be really the central theme. Asia's gone from about 55% exposure of the index to 80% today, where Latin America and EMEA, more cyclical regions, they've shrunk with negative commodity momentum and about halved their representation from roughly 45% to a little over 20%. But maybe that might be starting to change now that we're seeing cyclicals outperform.
Well, it's curious because during COVID, one would assume that emerging markets would suffer, yet they rebounded strongly and there was quite a significant bid. How would you explain that?
Yeah, I think a part of that has to do with the cyclicality we were speaking about. That these countries have also developed their own local capital markets, so they are more and more borrowing more in local currencies. So issuing debt in local FX to make sure that their cost base is aligned with their revenue streams, and that has reduced some of their dollar risk. So when we got that initial flight to quality dollar boom early in COVID, it wasn't as painful as it would have been in the past. And then speaking about COVID itself, EM fared a lot better than developed markets, and that's in terms of contagion rates, mortality rates, and also generally in regards to their economies. We saw developed markets GDP fall much more than emerging markets last year. And now looking forward, I think the IMF expects emerging markets to grow over 6% GDP growth this year versus about 4.5% for developed markets. And that starts with the big parts of EM, so China, Taiwan, and Korea, representing about 65, 70% of the index. These were the first hit by the virus, but also the first to come out of lockdown. So their governments did a much better job of containing the virus than what we saw in the West, which led to a much quicker rebound in economic activity. And then in the rest of EM, where we kind of had some problems in countries like Brazil, Saudi Arabia, Russia, South Africa, they had issues combating the virus, but still managed to avoid economic disaster, basically because these economies run with fiscal deficits and they don't have the luxury of the US's credit ratings or the ability to print money without restraint, as you referred to earlier, meaning that their governments and central banks really just can't keep their economies frozen while still keeping their citizens, who are their voters, in good shape. So bottom line, they've had to open up their economies sooner than in the US and in Western Europe. And then towards the end of the year, sorry, I'm rambling a little bit, but this is a key driver. We saw the dollar start to weaken because all of that, fiscal stimulus in the US and softer monetary policy in the US. And weaker dollar is just so important for EM. EM equities generally move up about 400 basis points for every 1% negative move of the US dollar. And after almost a decade of massive overweight to US dollar assets, we saw investors move to geographically rediversify their positioning. And that was because of the dovish monetary policy, the increased fiscal stimulus, and also just 2020, as you know, was a year of extreme political uncertainty that we haven't really gotten beyond yet. Even today, we're still uncertain on the possibility of increased regulation and higher taxes and minimum wage, which all could lead to lower U.S. earnings growth. So I think people are taking a bit of a defensive approach to rediversify themselves geographically.
Could this be the start of a brand new cycle?
It could be. That's what we see. I think that in regards to the dollar, we still see U.S. spending and probably more and more incrementally this year. Definitely still soft monetary policy is guided by the Fed. I think Chairman Powell most recently said that he's not even thinking about scaling back monetary support until further progress has been made towards maximum employment. I'm not very worried about interest rates rising, but they have been rising. So what do you make of that? Well, I think yields have been rising not because we have fears of inflation. We're still below the Fed's target, but more because people are more optimistic about growth. So that's not actually a problem. If rates do rise in EM because of a normalization of economic activity and normalized economic growth, then that's going to be a positive for EM. We saw that in 1998 and in 2004. And in these scenarios, we see global synchronized growth where EM acts as a beta, and EM tends to outperform developed markets. And then within EM, you see the cyclical regions, Latin America and EMEA, they tend to outperform Asia. The risk is if rates go up because of fears of inflation or an overheated economy, which I think we're still pretty far away from.
Yeah.
And if that happens, then that's more of a 1994 or 99 scenario where developed markets will definitely outperform EM. Inflation's a four-letter word in emerging markets, and within EM, Asia would outperform the more cyclical regions.
And we've really seen Asia, China specifically, become such a tech haven. I mean, a decade ago, 15 years ago, CNOOC and China Life were the hot stocks, and today it's Bilibili, Pinduo, and Baba. So it's so much more of a tech area at least from my vantage point.
Absolutely, and I think it's a really attractive theme in emerging markets as it's moving more, as we mentioned, into technology, into services, and consumption. And those are domestic industries, so you're really depending on the growth story within those countries and less on manufacturing something cheaply in an emerging market and then selling it to the US or selling it to Europe. So as these stories develop, you have less dependence on FX swings, on tariffs, on geopolitical tensions. It makes it sort of a more stable asset class.
Well, let's discuss valuation. What's your view on that in regard relative to the US, at least?
Well, relative to the US, EM looks attractive. Relative to history, or at least recent history, EM is about a standard deviation above historical averages. But that said, EM, as we've been discussing, has continued to evolve. So when it was sort of these old economy industries, those came with lower ROEs.
Well, PEs are a backwards-looking ratio. They're not going to tell you what's going to happen.
Correct. Absolutely. But then if you're looking at it with forward expected earnings, EM's still trading at the biggest discount it has to developed markets over biggest discount that we've seen in about 10 years.
Wow.
So it's about a 34% discount.
That's a great fact.
Yeah. And at the same time, ROEs have been creeping up. They're pretty similar to developed markets now. And EM's also offering higher dividend yields, which is pretty rare, and also higher growth, which EM generally does. So you're getting higher growth, higher dividend yield, cheapest valuation that you've seen in a decade, all while
what about China?
Profiles are similar.
I've heard recent guests speak nervously about the Chinese economy in the short term. Do you see it rolling over a little bit?
No, I think China is looking really, really attractive for this year. I mean, in terms of trade disputes, which, we're not exactly sure where the Biden policy is going to be there, but we do think it will be softer than the previous administration. Even if it's not, the headlines are way worse than actual numbers. I mean, China's a $14 trillion economy, exports about $400 billion to the U.S., which makes up about 3% of China's GDP. And U.S. only exports about 50 basis points of its own GDP to China. So the relationship is meaningful, but in regards to it actually affecting these countries' GDP growth, it's not that significant. And then more importantly, people focus on those headlines, but structurally, China is still the most powerful country in the world. This is a 1.4 billion person population moving away from manufacturing towards innovation and services. It's a powerful transformation that should drive their economy for really decades.
They love their tech and their brands right now.
Come again?
They love their tech and their brands.
Yeah,
high-end services are just killing it in China right now.
Yeah, and they've got a government that, despite the sort of recent investigations we've had into anti-competitive practices, big picture, the government really they support China's innovation and growth. In real terms, China's defense spending is close to converging with the U.S., and we see military spending as the basis for innovation. And I've seen on your programs, I think that you guys see that in sort of a similar light. Also, China's growing patents far more quickly than the U.S. China leads in artificial intelligence-related patent applications in scientific journals. And they by far lead in terms of bachelor degrees for science and engineering. So all of the above means that trade is less and less important because it's not where the future of growth is coming from anyway.
China's definitely the future without a doubt. India has always seemed to be, the future of EM, and never has quite, lived up to that billing. Is that going to change, or will it always be the, you know,
Yeah, I
underachiever?
think it's a good point. I think recently we've seen real changes that took a while to actually translate into growth. And by that, I mean, the benefits
I
of
mean, the
the
country's
rural.
infrastructure is terrible. Let's state that. I have more Indian and Chinese students than anywhere else, and China has an immaculate, gorgeous infrastructure that's going to support growth, societal growth, whereas India's infrastructure is, absolutely terrible.
That's true, but more, I think sort of represents some low hanging fruit because we have a government
It's
instilled
true,
that wants to
indeed.
address that. So yes, it's the infrastructure, but it's more than that. There's the creation of the digital economy to demonetize over 80% of the currency in circulation. Sure, that was sort of a short-term negative a few years ago, but definitely a long-term positive as you can track the economy better and improve tax collections and things of that nature. We had the introduction of the GST, which transformed India's 29 states into one market with one set of taxes, making things much more efficient and easier to do business. And then bigger picture in terms of demographics, and this is sort of the old story, as you mentioned, the country of tomorrow, but these things do come into effect and they will help drive earnings growth. With the largest youth population in the world, and that drives consumption. India's set to be the largest supplier of university or college graduates in the world this year. They have the third largest group of scientists and technicians in the world. And then in terms of what have we actually seen lately, some of the moves that we discussed earlier in terms of the World Bank's ease of doing business rankings, India's jumped 79 positions in the past 5 years from
Well,
140
Malcolm, I have another
to
fun
60.
fact for you. Indian Americans are the highest wage earning ethnic class, actually.
I believe it.
So,
The
on the reverse
education's
side,
phenomenal. Yeah.
Latin America. I was talking to the head of a major university in Chile, and he said we have no AI market here. There's just nothing here. How far off is Latin America from really, becoming a growth play, or what
Yeah.
are your feelings there entirely?
There are definitely some fantastic growth year companies, mainly out of Brazil and some in Mexico. But Brazil is a tough country to talk about today, given the Petrobras news we saw on Friday night and into tomorrow. So yeah, Brazil was down, I think 6.5% today, and Petrobras was down 20. But that being said, the situation's fluid, but this could be a pretty good stock pickers market right now. Brazil is trading at a significant discount to the rest of EM. And if we look at what happened, so last Friday, we saw President Bolsonaro name a former military general to lead the state-controlled oil giant Petrobras. And the market really respected prior management and had previously applauded the government's willingness to back qualified leaders in state-owned companies, which was a big change from the previous administration, referring to Dilma and Lula. So this was a very surprising move, and it kind of signaled a shift in the president's policies, maybe moving away from orthodoxy and more towards populism, and definitely gave the market a bit of a scare. But I think, given Brazil's recent underperformance, this creates an attractive landscape for stock picking. So bigger picture, what does it have going for it? The country's fiscal deficit is going to halve next year from 15% of GDP to 7%. 7% is still high, but when you move from 15 to 7, that's a big positive move. We just saw last week, or maybe 2 weeks ago now, Congress approved new legislation granting autonomy to the central bank. So having, that's basic for you and I and what we see in developed markets, but having an autonomous central bank that can disregard the wishes of the government and really focus on
Yeah,
inflation
no,
and
that's huge.
job creation, that's massive. And
Well,
then, sorry, just
no, keep going.
despite Bolsonaro's volatile actions recently, he still has a grade A finance minister in Minister Guedes that is still in his seat and still hyper-focused on really important reforms, such as maintaining a spending cap, tax reforms, administrative reforms, de-earmarking government expenditures, and a lot more. And then the last pillar of that is that they're coming off COVID really quickly. Yes, they were hit hard by it, but this is a country that has an extensive public health system, that has a really big history of dealing with other viruses and diseases. So they have a strong logistical capacity to distribute vaccines. And we think that it looks like the population age 60 and above should be fully vaccinated by June, which would be a major driver for the country.
We're coming to the end of our show. I want to ask one last question. Brazil's
Sure.
neighbor, Argentina, that currency has been in free fall for more than a decade. Do you see that changing? Do you see much of a future for Argentina?
I don't. We have this. We're back to Kirchnerism, Peronism, which is really leading to massive wealth
Of course.
redistribution, and there isn't much respect for traditional institutions and orthodoxy. And with that said, the international bond market just doesn't have much faith in the current government and these institutions. So
I always found it funny that Andrew Lloyd Webber glorified Eva Peron with a musical when, that family did terrible things economically to Argentina.
That's a very good point. I mean, great show though, but
great show indeed. Though.
Unfortunately, 50, 60 years of demise for the country. So I hope they turn it around. They do have midterm elections coming up end of this year or early next year. And, that could give signs for maybe the population has hope to vote someone like the previous president Macri back into office. But if that happens, I hope that they've learned their lesson, that, you can't kind of drag it out and expect to be able to institute these big changes over 2 terms. You kind of have to take the difficult medicine early on and make these changes to real institutions to gain faith of international markets, to be able to draw FDI back and bring inflation down, bring interest rates back down, and start investing and spending and, managing an orthodox economy again.
Well, wonderful. So this has been a great conversation, Malcolm. China's emerging tech. We see some potential in Brazil, and it was really a lot of fun talking with you today. Thank you so much.
And Avita. Yeah.
Indeed. Well, stay safe during these crazy times, Malcolm.
Great. Thanks so much, Alex. Take care.
Pleasure's mine.